Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to show how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Allianz Global Opportunistic Bond Fund. This video is done as a follow-up request from some viewers' comments in my previous videos. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. Allianz Global Investors, also commonly referred to as Allianz GI or AGI, is the original asset management arm of Allianz since 1974 and was properly established as a global integrated investment firm in 2012. Allianz is the world's largest insurance company and Europe's largest financial services company, so there is definitely a high degree of business stability for Allianz Global Investors. Another popular fund provider, PIMCO, is actually also a subsidiary of Allianz, though both asset management brands run independently. As of June 2025, Allianz Global Investors has over 700 investment professionals located in over 20 office locations globally, managing about 560 billion euros of assets under management or AUM. Assets are quite evenly distributed across equities, fixed income, multi-asset, and private market solutions. Considering insurance company-owned asset management businesses tend to be fixed income heavy, Allianz Global Investors is rather well diversified for its exposures. The firm doesn't follow a single investment philosophy or approach, but instead is open to different active investment strategies, which is probably an extension of its history as a conglomerate of boutique investment teams. The Allianz Global Opportunistic Bond Fund is a sub-fund under the Allianz Global Investors Funds or AGIF fund family. AGIF is set up as a Luxembourg SICAV company structure and is UCITS compliant. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The Allianz Global Opportunistic Bond Fund has some inconsistent manager information. The fund webpage shows the fund is co-managed by Ranjiv, Filippo, Carl, and Jenny. The fund fact sheet doesn't have Jenny though. Morningstar information shows that instead of Jenny, there should be Gaurav and Thomas in the manager list. From this Morningstar chart, we can also see that there have been multiple changes in the managers for this fund. At the moment, Ranjiv and Filippo looks to be the longest serving managers for the fund, though they are in this role for only 3 and 2 years respectively. The numerous changes in the managers for the fund over the years is a concerning matter, as it suggests instability in the team and the style of the fund can potentially change whenever a new lead manager takes over. Allianz doesn't provide any manager bio in its webpage and documents, so I am relying on the bios available in Morningstar. Let's look at the 3 co-managers that are found in all the data sources. This fund is run by a team called Core Fixed Income in Allianz GI, and Carl is the CIO of the team. He has 35 years of industry experience, mainly in core and aggregate bond strategies. He is just added as a manager for the fund in April 2025, and I'm not sure why there is a need to do so. Ranjiv is a senior portfolio manager with 32 years of industry experience, mainly in macroeconomic research and sovereign bond strategy. Filippo is the junior in the team with 7 years of experience. From the bios of these managers, it seems that the fund will have a heavy focus on sovereign bonds in the portfolio. The Allianz Global Opportunistic Bond Fund has a short investment objective that says it aims at long-term capital growth and income by investing in global bond markets. By having both capital growth and income suggests that the fund is looking at total return perspective, instead of focusing on generating high payout yields. Global bond markets is quite vague, though with the opportunistic in the fund name, this may point to a diversified and unconstrained strategy. We will see if there are more details in the prospectus. The prospectus unfortunately doesn't provide much details, which is the norm for Allianz funds. There is an additional sentence talking about the investments in the fund spans across a spectrum of macro and credit opportunities, which implies the flexibility of the strategy and diversification of the portfolio. Key limitations defined include maximum 30% in high-yield bonds. That implies the fund needs to have at least 70% in investment-grade exposures, so the fund should most likely have a net investment-grade credit rating at all times. There is also a max 30% in emerging market bonds, of which max 20% in China bonds. We will see how much of this limit is being used, as most global bond funds tend to have minimal exposures in emerging markets. There are also other non-fund specific restrictions, including max 20% in securitized assets, max 10% in COCOs, max 10% in preferreds, and max 10% in other funds. The last limitation is on the duration, with a very wide range of 0 to 9 years. This is broad enough for a bond fund to cover all types of interest rate environments. Lastly, the benchmark of the fund is stated as the Secured Overnight Financing Rate or SOFR. SOFR is typically used as a guideline for short-term deposit rates and is usually similar to 1 to 3 month US Treasury yield. So this is really a low bar benchmark for bond funds to try outperform. SOFR is currently around 4.1%, although it should get lower if US continues with its rate cuts in the coming months. Given the lack of details in the fund prospectus, we will have to try find other sources of information to understand the fund better. The fund fortunately has a marketing brochure or leaflet available for download, although it strangely only appears in some of the share class web pages. For example, I see it in the US dollar accumulation class, but not the distribution class. The leaflet contains very useful information to explain what the fund strategy really is. Here, it tries to show the fund adopts a highly diversified and liquid portfolio across bond segments, and mentions that the investment approach combines top-down macroeconomic research with bottom-up fundamental research on the bonds. The right side shows the historical changes to the bond segment allocations in the portfolio as a result of active portfolio management. It is mentioned here the fund is benchmark agnostic, although it is a given as the benchmark is SORA, which is not investable. It is also mentioned that the fund offers diversifying uncorrelated returns from traditional global aggregate strategies. Now, global aggregate bond portfolios typically have significant allocations to sovereigns, so we will see later how the fund portfolio looks like and how its returns have been comparing to global aggregate bonds. The leaflet also stresses on the risk management approach as a key selling point of the fund. Again, we will see later how this translates to the fund volatility and drawdowns. There is an additional max 50% limit on inflation-linked bonds shown here that is not mentioned in the prospectus. The last key point in the leaflet is about providing stable monthly dividends. This is expressed via the distribution share classes, which we will cover later. Personally, I will focus more on the total return generated by the fund before looking at the sustainability of the distributions. Overall, I think I should summarize the fund strategy as a global diversified, unconstrained, net investment grade bond strategy with high flexibility on its exposures, and that it aims to outperform SORA over market cycles. The Allianz Global Opportunistic Bond Fund was incepted in 2015, although the earliest available retail share class was incepted in December 2016, giving about 9 years of track record. The fund has an AUM of about 819 million US dollars as of end August 2025, which isn't too big compared to other popular global diversified bond funds in the market. The sector breakdown shows about 70% in government bonds, 20% in corporate bonds, and 7% in emerging market bonds. This is, however, still too high level to understand the portfolio, and it would be better if the breakdown is more detailed. Bringing back the charts from the fund leaflet, even though they are dated 2 months earlier, gives us more details. We can see that the government bonds portion actually has about 20% allocated to inflation-linked bonds. So there is a deliberate tactical bias on this. Corporate bonds are still mainly investment-grade credits, as only a small allocation is in high-yield corporates. The chart on the right gives the best details, where we can see the allocation in US Treasuries have been reducing, especially since 2023, in exchange for allocations into inflation-linked bonds. Non-US government bond exposures have been kept at around 15% though. Corporate-wise, high-yield exposures have been less than 10% through the fund life, and there is an increase in investment-grade credits since late 2024. Emerging market exposures used to be more substantial in the earlier years, but have been trimmed down since 2023. This is a very useful chart of historical allocations to bond segments, but it is not easy to obtain, as some fund providers do not make this readily available. In this case, Allianz has put this chart in the fund leaflet, so investors who missed out the document won't be able to see it. From the portfolio exposures, this translates to a pretty diversified country breakdown, where US is not too excessive at around 58%, and the rest spreaded across the world. This is quite different from US-focused solutions such as PIMCO GIS Income Fund that typically have 80 to 90% US exposure, of which a substantial allocation is into securitized assets such as MBS. The portfolio currently has a high AA- average credit rating. This is due to the pretty high allocation to sovereign bonds, and also that the fund has a very low high-yield exposure. In this case, only about 6%. While the portfolio has a high credit rating, it clearly has an impact to the yields. The average coupon of the portfolio is 3.48%, while the yield to maturity is 3.69%. This looks slightly lower than the popular global bond funds that currently still has around 4 to 6% yield to maturity or yield to worst. This also has an impact on how we see the distribution yields, which we will go through later. The effective duration is currently 4.51 years, which looks to be in line with most other funds as active bond managers are observing the intensity of the US interest rate cuts in the coming months. The fund surprisingly has a really small number of holdings of 79. Most global bond funds typically have hundreds, if not thousands of holdings for diversification. I suppose this is only possible because the bulk of the portfolio is in sovereign bonds and inflation-linked bonds, where the fund can buy significant amount of the same bond, as seen in the top 10 holdings. The fund doesn't have a full holdings list available, so I am quite curious how it handles corporate bonds and whether there is really enough diversification across issuers. Morningstar data provides a very different view of the fund portfolio though. The data shows the portfolio has a lot of non-bond holdings and significant short exposures, implying that the fund actually uses derivatives quite extensively. This is also seen in the top holdings in Morningstar that has credit default swaps and futures positions. There is, however, no mention about derivatives usage in the fund prospectus, so we wouldn't know if there are any guidelines or limitations. I hope the fund will not somehow evolve into a fixed income macro hedge fund strategy in the future. The Allianz Global Opportunistic Bond Fund has quite a few share classes and currency classes for retail investors. A refers to the usual retail share class for Asia investors. AT refers to accumulation share class. This is available for both US dollars and Sing dollar classes. AM refers to monthly distributing share class. The additional G refers to gross distribution policy, whereby the management fees and other expenses are factored into the NAV instead of the distribution. Currency hedging costs, however, are factored into the distribution. There is also another version with an additional F that refers to fixed percentage policy, whereby the distribution yield percentage is fixed every month. The percentage may be adjusted depending on market conditions. As the fund is base currency in US dollars, all non-US dollar currency classes are currency hedged and denoted with H2. The only exception is Hong Kong dollar class, as Hong Kong dollars is range pegged against US dollars currently. The earliest incepted retail share class here is the AMG US dollar class that was incepted in 2016. The rest were progressively launched in subsequent years. These share classes charge a 1.14% per annum management fee. Adding other expenses gives a total expense ratio or TER of around 1.2% per annum. Up to 50% of the management fee may be paid by Allianz to distributors as trailer fees. This fee level is similar to most other global bond funds in the market. Distributors are allowed to charge up to 3% subscription fee for these share classes, although I think 1% or less for a low return bond solution like this would make more sense. The Allianz Global Opportunistic Bond Fund fact sheet provides a nice summary table on the annualized distribution yields across the different share classes. We can see that the fund currently has a 5.88% on its base US dollar class, which looks rather high for a portfolio that has a yield to maturity of just 3.69%. So this likely means that the share class is taking some capital to top up to the payout. We can also see how currency hedging costs impact the yield across the different currency classes. For example, the Sing dollar hedge class currently looks to have a currency hedging cost of around 1.5%, which is not a small amount if the expected total return of the fund is not high. The AMF share class, or the fixed distribution percentage class, looks to be paying out even more at 6% distribution yield. Let's see what this really means for investors. Here is a since inception chart for the AMG US dollar class showing total return versus NAV. We can see the fund delivered about 20% in the past around 9 years, which roughly translates to just 2+% per annum on simple math. Bearing in mind this is a 20% total return. The NAV looks to have been dipping down over the years, totaling to a minus 16.6% loss. This means if an investor started investing in this share class 9 years ago for $100, he would have lost $16.6 on the NAV while getting around $36.6 worth of distributions by now. Is this a worthwhile investment? I personally don't think so. Most bond funds that I covered had managed to stabilize the NAV after COVID and either kept the NAV in a tight range or slowly made some NAV growth. However, this fund seems to be prioritizing maintaining a high payout yield instead of growing back the NAV, which I don't really like, because a declining NAV means investors are losing out on compounding growth potentials in the investment. The Sing dollar hedge class has a shorter track record, though the same can be observed on its total return versus NAV chart. So unfortunately, while the fund is trying to provide a high distribution yield to be competitive versus other global bond funds in the market, the total return generated by the fund doesn't seem to be high enough to cover for the distribution yield. Let's review the fund performance in more details next. The Allianz Global Opportunistic Bond Fund webpage has a dynamic performance chart, as well as performance tables for past 5 calendar years and various time periods. However, these are without comparison versus the benchmark, so they are not too useful as we can't tell if the performance is good or bad. The fund fact sheet has lesser performance data, although it does include the benchmark data as well, so that's more useful. As usual, I will suggest to ignore the offer to bid data as it includes an assumed maximum subscription fee, which is not relevant to the performance of the fund itself. From the data, we can see that the fund has underperformed the benchmark for 3 and 5 year periods. Considering the benchmark is SORA, this does look quite disappointing. 1 year period has been better, as the fund is on par with the benchmark, and this is mainly due to a strong outperformance year to date. We can also see that the fund appears to be running a pretty low volatility strategy. However, because the long-term returns have been poor, the resulting Sharpe ratio has been negative. We can't get much more insight beyond this, so let's run some Morningstar charts. Here is a full performance chart of the Allianz Global Opportunistic Bond Fund AMG US dollar class since inception in 2016. As the benchmark SOFR is not directly investable, I have included here the Amundi Fund's Cash US Dollars, which is a US dollars money market fund as a proxy for SOFR. We can see that the Allianz Fund had periods of outperformance in the past, though the main detractor of recent years was the big correction in 2022, when the rapid US rate hike happened. If we adjust the time period to start at the bottom point of 2022 in late October, we can see that the Allianz Fund has been delivering about the same returns till now as the money market fund, showing the fund has not really been able to outperform in recent years. The decent outperformance year to date is in fact a catch-up from the underperformance in 2024. This is quite a gap compared to some of the popular global bond funds in the market. For example, if we compare against PIMCO GIS income, as well as other similar US securitized assets heavy strategies like Neuberger Berman Strategic Income and JP Morgan Income, we can see that the Allianz Fund runs a rather different performance history that has a lower volatility but also lower return characteristic. Here are some other popular bond funds that have heavier plays in sovereign bonds in their strategies, such as M&G Optimal Income, BlackRock Fixed Income Global Opportunities, AB American Income, and Amundi Global Aggregate Bond. These have all outperformed Allianz as well through this time period. The consolation is that the fund appears to have improved this year, with year-to-date performance much more similar to other global bond funds as seen in this chart. So the Allianz Global Opportunistic Bond Fund clearly has a problem with its long-term low performance. I am not sure if the strategy was too defensive or if the bond selection process needs to be improved, but the fund needs to focus on generating better returns going forward instead of prioritizing giving distribution yields comparable to competitor funds. Whatever that has changed in the fund this year seems to be on the right track, with a much better performance comparable to competitors, though the fund needs to continue to work hard to stay competitive and make up for the prior underperformance. With that, let's summarize our findings. Allianz Global Investors is the asset management arm of Allianz, the largest insurance company globally. The business AUM isn't as big as some of the other fund providers, but having a big-sized parent helps to ensure stability of the business. The managers handling the Allianz Global Opportunistic Bond Fund has changed several times since its inception, with the longest tenure of the current manager team only about 3 years. This is a concern as manager changes will bring about changes in the investment style of the fund. There are no details available on the investment strategy and process of the fund. It would be useful to provide, for example, some elaboration on how risks are managed as part of the portfolio construction and bond selection process so that investors can understand the fund better. The marketing leaflet helps to provide some details, although it is not a mandatory offering document, and therefore some investors may not know its existence. If I summarize the fund in my own way, I would call it a global diversified, unconstrained, net investment grade bond strategy with high flexibility on exposures, aiming to outperform SORA over market cycles. The portfolio appears to be rather defensively positioned, with a high AA- average credit rating and mainly sovereign bond exposures. The payout yield of the distribution share classes, however, looks too high and not sustainable by the fund's long-term returns. This is a result of a generally low return generated by the fund in its long-term track record, causing the fund to lag behind popular global bond funds in the market as well as its own benchmark. Year-to-date performance seems to have improved, although the fund needs to keep up the pace and make up for prior underperformance. In summary, performance is the key concern for this fund. The fund will need to generate longer periods of good performance to show that it can be on par with the other popular global bond funds in the market. As of right now, investors have many other attractive picks in the market instead of this fund. This concludes my absolutely biased comments on the Allianz Global Opportunistic Bond Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.